Floating exchange rates or flexible exchange rates are exchange rates where there is no intervention by the central bank to manipulate the price of the currency. So for now, we are working with a flexible exchange rate regime. Now, if we have a flexible exchange rate regime and the central bank of that economy conducts expansionary monetary policy, how do you think this will affect the exchange rate? So if the domestic interest rate is going down, remember from our capital flows and the movement in our financial account that the lower domestic interest rate means that people would rather invest abroad. So overall, we'll have a capital outflow happening from the Canadian economy. Now, this capital outflow is telling us that for the domestic residents, they'd rather put their money abroad. If they want to buy foreign stocks and bonds, they must be selling the domestic currency. So as they are selling more of the domestic currency, the supply is going to increase for the Canadian dollar. So the supply curve shifts to the right. This capital outflow also means a change in the behavior of foreigners. So as foreigners are now buying less of our assets, demand for our assets is going down, and therefore the demand curve for the Canadian dollar is going to decrease. So as supply is increasing because we are selling more Canadian dollars, demand simultaneously is decreasing. So demand curve is shifting to the left, supply curve is shifting to the right. As the two curves adjust, we see that the value of the Canadian dollar is going down. And with the lower price, we can say that the domestic currency has depreciated. So expansionary monetary policy, which lowered the domestic interest rates relative to the foreign interest rates, have led to depreciation of the domestic currency. How will this depreciation now affect your current account and your financial account? Lower value of the dollar means that our goods are cheaper for foreigners, so exports are going to go up. Lower value of the dollar also means that foreign goods are more expensive for us, so imports are going to go down. Higher exports and lower imports will ensure that our merchandise trade balance or net exports go up. Higher net exports, which are a major component of our current account, will cause the current account to increase. So note, a depreciation of the domestic currency is causing their current account to go into a surplus or making the surplus become bigger. Whatever happens to your current account, remember the equal and opposite effect will happen on our financial account. So that means our financial account is going to decrease. So how does this depreciation affect our macroeconomic variables like the aggregate price level, real GDP, and the unemployment rate? Remember, AD is C plus I plus G plus net spending by foreigners on our domestically produced goods and services. So the depreciation is causing net exports to go up, aggregate demand to further increase. Remember, the expansionary monetary policy is already expanding your consumption spending, stimulating our investment spending, and now also through the depreciation of the dollar, causing our net exports to go up and overall stimulating aggregate demand, putting upward pressure on our price level, real GDP, and downward pressure on unemployment. So with flexible exchange rate regimes, we see that our monetary policy works in part through exchange rate movements. The lower interest rate is putting downward pressure on our exchange rate or depreciating the Canadian dollar and putting upward pressure on our net exports. For contractionary monetary policy, it would be the exact opposite. A higher domestic interest rate will cause capital inflows. You'd rather invest money at home as a domestic residents, and foreigners are bringing their money in to buy Canadian assets. This causes the demand for our currency to go up, the supply of our currency to fall because domestic residents are no longer selling their currency as much as before, and together these two movements put upward pressure on the exchange rate. The value of the domestic currency will go up. An appreciation will cause exports to go down because our goods are now more expensive for foreigners, and since foreign goods are cheaper for us, imports will go up, and together these two cause our net exports to fall or our current account to decrease. A decrease in current account is equivalent to financial account increasing. Our net borrowing now has gone up over here, and in terms of our aggregate demand, a lower net exports is causing your aggregate demand to go down, together with consumption going down and investment going down because of contractionary monetary policy. AD is declining and putting downward pressure on inflation, downward pressure on real GDP, accompanied by a higher level of unemployment. So understanding of the exchange rate is not only just important for ensuring that how our balance of payment account is balanced, but it also helps us in understanding the use of an independent monetary policy with free flow of capital and a flexible exchange rate regime.